The broadcast is now starting. All attendees are in listen-only mode.
Hey everybody, just wanted to say hello to everyone. We have a very exciting session today regarding financial structures and all the different kind of structures that we can use to do a development. The ones that I can use, or ones that I have used for the development. Sorry, can you just press the hand button so I just know for sure that everyone can hear me, see the screen, everything is good? Okay, fantastic, right. So we'll just continue because I'll just give it a few more seconds. I think we're going to be 7 o'clock very soon. Okay, we are 7 o'clock, so we can begin. So we're going to talk about different structures and why we use them, what are the benefits, what are the advantages and everything. And we're actually going to talk about the structures that I've used in the past. And the reason is this is a very specialized field, and the government actually, not the government, the ASIC actually regulates people who are authorized to give you advice on this. So I've got to put a disclaimer out, which is saying that you need to get any kind of specific advice from your accountant, lawyer, or financial planner. I'm not here to advise you on any structure whatsoever. I'm only going to talk about the structures that I've used, the structures that are available to me, and the different advantages and disadvantages of these structures, and how we structure a deal using these financial structures, and how different parties can come together to do a particular structure. And so I've got to put a disclaimer out saying that get advice from your accountant. I only know what I have come across and what suits my financial needs. I cannot advise you on taxation, financial structures, self-managed super funds, and accounting related matters. Seek professional and independent advice with respect to any financial, taxation, super, or accounting matters. This content is not an advice. So I'm not here to advise you to do this is what you need to do. Every circumstance, every development is different. The things that you want to achieve out of that development are different. There are different needs that people have, and that is why different structures are suited to them and not to others, or could be different structures suited to the development or what you want from the outcome, or how the profit's going to be distributed, what are your tax implications. So everything is suited based on your needs. So it's that this is so much specialized that even an accountant will not give you an advice on super or self-managed super fund unless they are certified to do so. So they will actually refer you to somebody who's got the certification or has the license or whatever, that they can advise you on different structures. So let's start. And I'm sure by the end of this session, you will have a lot of questions that you will want to ask me. The ones that I can address and the ones that I've gone through in my past would be very generic. I can tell you from my point of view how that works, but I will not be able to say, if this is what you're wanting to do, this is what you should be doing. I would be asking you to go and ask your accountant if this structure would be the right structure for you. So the advice would be, there will be no advice and everything. It'll be a question to you to ask the question to your accountant. So yeah, I do not want to be dragged into any kind of thing, any kind of litigation where people point a finger at me that I advise them to do that. I don't advise anybody to do anything with finance, taxation, super, accounting matters. So yeah, but as developers, you need to understand how these things work, so that when you structure a project, or when four people get together and they want to do a project, and I know that John's been sending me some questions, and I will give you an opportunity to talk so you can discuss what you guys are wanting to do, and then I will point you in the right direction where you will go and ask questions to your accountant, you'll go ask questions to your lawyer, because they are the best suited to advise you of what to do. So there are some important consideration. For example, who should receive anytime you set up any structure where you're actually going to do the development, or you're going to buy an investment property or anything, you need to go and talk to your accountant, and your accountant will be asking you these questions. Now, anything that I'm teaching here is not something that I made up. This is all at the end of the session. I give you all the resources where you can find a lot more detail than I've given you. They are free resources available to you that you can go and read up more. so that when you go and see your accountant, you can ask them the right questions. You can take notes of what your present situation is based on this content, and then go and ask your accountant, this is what I want to do. How can I go about doing it? So they'll advise you what to do. Who should receive the capital both now and in the future? So if you are planning to do a development, these are the questions that you need to ask yourself. So who should receive the income both now and in the future? Is there a need for investment assets to be protected against potential future creditors? So we buy investment properties in different structures also for asset protection, and there are different instruments available. Are there any special family consideration related to who should own the assets or receive the income both now and in the future? And I'll give you an example where in some cases where my wife is the beneficiary in one of the trusts that I own, but she's not the director anywhere. So that if something was to happen to me, she is still a beneficiary. And but for all legal purposes and all of that, I'm the director. So if somebody was to come after me, they can only come after me or the asset owned by that trust. They can't go after the beneficiary as such. So are there any special family consideration? Sorry, I've already read that. What level of flexibility is needed as far as debt and leverage is concerned? What are the tax implications of each structure? What estate planning issues need to be addressed? So these are standard questions that your accountant will ask you when you are setting up all these questions. So it would be better if you were prepared to answer these questions when you go and see them. So if you don't understand what these questions exactly mean, you can ask your accountant to clarify them for you. And I'll show you some examples as we go along, and I'll show you what are other things. So there are 4 basic investment structures. So as an individual, as a partnership, as a company, and trust, there are 3 different main kind of trusts: discretionary, unit, and hybrid. I've never used a hybrid trust, but I'll just sort of touch on it, what it is all about. But I've used discretionary and unit trusts myself. I don't do anything in the individual name ever because that's not a good taxation strategy for me, or it's not a good choice to do that, and we'll explain that in a second. I've done partnerships, I've got companies, and I've got trusts that I use. So when you do individuals, it's the most common and simple. You go and buy a property in your name. That's it. So it's easy to set up and manage. But what happens is anytime you make an income from an investment property, because you own it as an individual, so the taxation office will look at your entire income that you are making. It could be a job, it could be a business, you could be a shareholder somewhere where you earned a dividend. So anything that went under your name will be combined and put together as a total income, and then you'll be taxed on that. So that's how this works. So easy to administer, as there is much less paperwork in comparison to other structures. So it's just you go in, sign it, and you're done and dusted. It doesn't have any cost of running this. It's more tax effective, especially if the investment is negatively geared. Now, I am not a very big fan of negative gearing, but when you're making a ton of money, there is no other option, and that is why people do negative gearing. But as a developer, I do not do negative gearing. The reason for that is we've got to sign up on loans every few months, and they look at us and they say, look, oh, you're already negatively geared, but that means the income that I'm making is used to service an existing debt. So when we have to go and borrow more, the bank will not borrow us more. So that is why I try and keep everything neutral and positive. And not only that, it's good passive income. Those days where you could keep borrowing as much money as possible to control as much property as possible, those days are gone because APRA's cut down on them, and finance isn't available as quick. So that's an old school strategy, and it won't be as effective here unless you are on a very high income bracket. So it's much less tax advantaged if the investment is the family home. So now when you buy a family home, it's best to own it in your own name or in your wife's name, depending upon what your accountant would tell you, because family home is exempt from capital gains tax. So if you claim it as your PPR, which is your primary place of residence, and you sell it at a later date because you live in that property, the government gives you an incentive of no capital gains on that one property. So it's best to have it in your own name. No flexibility with the distribution of income. So when you start making money, you can't say, look, I made $500,000. I just want to distribute 200K in my wife's name, so that we can reduce or come down in a bracket or where to minimize your tax liability. So you'll be paying tax on the full amount in that scenario. So individual in high risk occupations could be sued and their assets exposed to risk from creditors. So what happens in these scenarios is that if you own a property in your name and you get sued for whatever reason, I don't know, maybe you're a doctor, somebody sues you because you gave them a wrong injection, or if you are I don't know, high risk professions where your individual professional, it's called PI insurance, professional indemnity insurance, where you as an individual can be sued for something. What will happen is, in case you lose that case, or anything that you own in your name is up for grabs. So that is why that asset protection part of it kicks in, where you need to understand that, okay, I'm going to make all this money and everything, I need to be protected and everywhere. Now, if it's a bank, if it's a divorce, the court will see through all of that. So it doesn't matter if if it's a bank, they'll always have a personal guarantee. So they will get to you. There's no way around it. So it is only from a third party perspective where, I don't know, you go and play golf and you hit somebody on the head with your golf ball and that person comes and sues you. So anything that you own in your name, if they win the lawsuit, and there've been some stupid, lawsuits around where, somebody breaks into a house and the dog bites their finger off, and the thief actually successfully sues the owner because his dog bit his finger off because he can't work in the industry that he used to before, and they've been successfully able to sue the homeowner. So if that homeowner has lots of assets in their name, so whatever the lawsuit is, everything can be sold to pay the person who sued them. So it's just that's how the law is. So if somebody breaks into your house and you break their head, you get sued, not that person. So that's how this is. There's nothing I can do about it, and nothing you can do about it. All you can do is protect yourself. And the best person to ask advice on protection is your accountant, not me. I'm just explaining you. I'm just making you aware that these are the things available out there, and you need to you need to start asking questions to your accountant and everybody. And these things will change the way you set up your structures at different times in your life. So you could be planning for retirement, so it's a different structure, and self-managed super funds and all those things will start coming into play. You're just starting out, you're still young, and everything is fine. You don't own any property. It's going to be a different way you're going to approach something. Let's say you're in your mid 40s, and you already you have wife, kids, you've got other assets, you've got a family home, you've got an investment property. The advice that you get from your accountant will be totally different in that scenario. So it changes from different stages in your life. So as an individual, there is no flexibility or distribution of income. High risk, negative gear assets held in an individual will eventually become positively geared, resulting in an increased tax liability. So as you pay down property that you've been negatively gearing and it becomes positive, then that means you're paying tax on the income that's coming in. So so the same advantages and disadvantages apply to assets held jointly. So if you and your wife or your brother or whoever own something jointly in your individual names, even if you own a property together, let's say you and your brother or your sister or your wife or anybody, individually, all these things, the same things will happen. So a partnership, on the other hand, is a relatively simple structure, and it has different costs to set up it's fairly low. So all it is that you could have two different structures and you could set up a partnership. That partnership would have its own ABN number and tax file number. And the way that works is that the partnership doesn't really pay any tax. So if the partnership makes $100 and you and your friend have that partnership for 50-50, you get $50 and they get $50. And as an individual, then the taxation office will look at your entire income, add that 50 to your entire income, and then give you and that's how your tax would be assessed. So, however, it does not pay tax but must distribute income to the partners. So, the only thing that this will pay is the GST. So, if you do a development as a partnership, and I've done that, and that is why I'm talking about it. My first development in Brisbane was a partnership of two different trusts. I had a family trust. My partner in the development had a family trust, and both the family trusts were then combined to form a partnership. The partnership got its own tax file number, its own ABN number, its own bank account. And setting up a bank account is a pain because most people who help you set up the bank account of a partnership won't understand what it is. So it takes a while to make them understand. It took us an hour to set up that partnership. So so that's what this is all about. And when anything comes into the partnership, it just gets distributed based on the where you set up your partnership. So partnership offer limited distribution flexibility, as any income derived has to be split according to the partnership agreement. Holding a property as joint tenants or holding shares in joint names is usually not considered as a partnership. So that's not a partnership. There is no risk protection in partnership, as the assets of either partner may be subject to a claim by a creditor, as all partners are jointly and severally liable. So what does that mean? So what it means is that, let's say all of us get together. So all of us get together, 5 of us get together, and we form a partnership. And we go to the bank and we buy a property. So we've got one property in one partnership, and there are 5 different partners. So it doesn't matter if I hold 40% of the partnership or 50% of the partnership, or somebody else holds 60% of the partnership and somebody else holds 10% of the partnership. We are all liable for the development. So if the development goes under for whatever reason and the lender is going to come after you, they can come after any one of you or all of you. So there's not like I'm only liable for 10% of the development. No such thing. If they think that you have a lot more money than anybody else, they might decide to come after you, or they might decide to come after everybody collectively. So it is just totally at the bank's discretion. This means that only partner could become personally liable for all debts of the entire partnership. Yeah, so what this is saying, it means is that this means that one partner could become personally liable for all the debts of the entire partnership. So that also could happen. Companies are often used as a structure for business rather than for investments. So the only difference with a company is that the main benefit is that the tax rate on profits is 30%. So if the company makes $100, there's 30% tax. That's it. And they offer some protection for shareholders if the business fails or is sued. However, now I'm not going to just sit here and read all of this, but I'm going to try and explain it to you in a nutshell. Companies are really good to do a business. So when you're running a business, it's pretty good. And shareholders could be other people who have vested interest in the business, but it could be somebody else. You could hire a director who's running that for you. But when it comes to developments, unless it's a massive development and you already know that the development is going to make 50 million in profit or 10 million in profit, you want to make sure that you cap the amount of tax that you want to pay. So in that scenario, you just pay 30% and that's it, and you can retain the money in there, and the shareholders will get dividends, and those shareholders will then be assessed on their individual tax returns and so on. But here's the difference. The way companies work is that if you make $100, before anything is distributed to anybody, 30% goes into tax. So what have you got to distribute? Only 70%. So out of the $100, 30% is just gone to the taxation office, and there's $70 left to distribute to all the shareholders. And that's not a good thing. But because when you compare them with different trusts, and that is why a lot of people, a lot of developers, and including me, I prefer to use trusts, because if $100 comes into a trust and there are 5 different investors, that $100 get distributed to 5 different investors. There's no tax that the trust is paying on that $100. And it's the individual who's got $20 each, let's say, who needs to then look at his own taxation, his own tax assessment of what he is going to pay there. So, however, there are also disadvantages. For example, these are the disadvantages. The cost to set up can be high. So, let's say it costs about $1,000 or $900 or something to set up a company. But they come with different legal things that you got to do. You got to pay the ASIC fee every year, all those things. So that's what a company is. So let's look at different trusts because they are the most popular investment structure. But a lot of people don't understand them, and that's what you need to do. So briefly, the trust is formed by executing a deed which documents the establishment of the trust. So what does that mean? So a trust is only good as the deed, because the deed specify exactly what's going to happen in the trust, how you're going to distribute the income, how you're going to distribute whatever it is. It's all in the deed. Now, trust deeds can come online. I mean, they are very cheap and you can get them online. But I do not recommend anybody just hopping on the internet and buying stuff. It is always better to talk to your accountant. You tell your accountant, this is what I want to achieve, and those deeds based on your requirements are then drafted by specialized people, and then a trust is formed. So if you could think that I've got the trust, but if the deed doesn't allow you to actually distribute your the income or the profit or whatever, and you do that, you can get sued, or ASIC will come cracking on you because the deed doesn't allow you to do that. So that is why, instead of trying to be a hero and say, look, I just saved money because I went on the internet and bought a trust deed, unless you know what you're doing or you've got specialized training in that. I haven't, so I've never done that, and I never would, because it's a specialized field. I trust my accountant, what he does, and he knows what I'm planning on doing, because I always discuss every development with him before we form the trust. I tell him that's the scenario, that's what I want to do, and towards the end this is what we'll do, and then we will maybe retain a unit, or maybe in the end we won't change any hands, or we'll just sell everything off, or whatever the scenario is. You need to tell your accountant, and based on that, the accountant will recommend you. This is the kind of and the accountants in turn further go to specialized people who then put these deeds together, because they write everything in there, and then based on that a trust is formed. Now it costs about to me, a trust with the corporate trustee is about $2,500. That's what I pay. You can get them cheaper. You can find a lot of people, but I don't do any kind of negotiation with my accountant in this respect, because I call my accountant a lot and I never get an invoice for it. So I know that there's this like an understanding where I pay even when I get an ASIC yearly fee that I've got to pay. I get a $200 invoice from the accountant for doing so for me, but I never dispute any of these things. I just pay it because I know that I call my accountant more often, and if he was to start billing his time for every time I call him, my overall invoice would be higher. So that's just something that I do. So yeah, it costs about $2,500 to set up a trust, whether it's family or unit trust, with the corporate trustee. So and I'm pretty sure that the accountant makes another $400 or $500 in that, and the cost to the accountant would be maybe $1,800 or $2,000. So that's fine. I've got if someone else is doing the work, I've got no issues them making the money. So the settler gifts the settled sum. Now there's a settler involved. So who's a settler? Who is often your accountant, is usually an independent person unrelated to the trustee or the appointer of the trust, because the settler cannot be the beneficiary of the trust. So the settler is usually the accountant, and the settled sum is usually a nominal $10, $20. So what the accountant does is pays the $10, $20 and sets it up for you. And the trustee may be either a natural person or the person or a company. Now, you could be an individual, like I could, for example, Amber as trustee for XYZ trust. I could be the trustee of my own trust. But I always prefer to have a corporate trustee, and we'll get to that. Why do we do that in a second? The trustee determines to whom and in what proportion the income assets of the trust are distributed. Now, I prefer a corporate trustee. Why? Because if I was to, die someday, another trustee would have to be appointed in that scenario, who would then decide how they're going to distribute the proportion of the income or the assets, and I don't want that. So that is why I keep a corporate trustee. So even if I die as a director or something, the shareholding and everything is still available. The corporate trustee still stays there and can make the decision, and whoever owns the maximum amount of shares in that is the person who controls the corporate trustee. So there are four main types of trust: discretionary, unit, hybrid, super funds. So we'll go through them very soon. The appointer, usually the person establishing the trust, has the discretionary power under the trust deed to remove and replace the trustee. So who's an appointer? Appointer sits on the side and they can actually fire the trustee, or they can change the trustee from an individual to a corporate, or from one corporate company to another corporate company. But there's paperwork involved in all of that. So the appointer has the power to nominate a successor on his or her death, and failing any such appointment, the personal representative of the appointer will become the new appointer. So usually, in my family trust, I'm the appointer. It's basically, if I was to die and if I was to say, look, my assets are carried on with my kids, after that, I can appoint them, and they take control of the trust when I die, rather than the actual property changing hands. So that's why we have an appointer. The specified beneficiary are usually the husband and wife or partner, and so by definition the range of beneficiaries include any children and any related entities. So any companies in which the specified beneficiaries or directors or shareholders. So when I visually explain it to you, you'll understand what this is. So any money that comes in can go to me, go to my wife, go to my family, if it's a family trust. So that money can be distributed. So there are other technical stuff here. The trust can also retain income, and if that income is taxable, then tax is payable at the top marginal rate plus the Medicare levy. Don't ask me all of these things. These are very accountancy related questions. Ask your accountant what all these things are. So losses can be carried forward to offset against future income. So I told you a story about a company that I had, and I racked up $450,000 in loss, importing textiles and everything. Well, I didn't shut down that company, and now that I've made my profits and everything, I've managed to recoup all of that loss because I carried forward the loss in that company, didn't shut it down, didn't change the shareholding, didn't do anything, and I was able to offset that income against the losses that I had made in the past. So, which is pretty good. So a trust can also retain income, and if the income is taxable, then the tax is payable. Okay, we've already discussed that. So let's keep going. Discretionary trust. The trustees of a discretionary trust are able to distribute income and capital gains to beneficiaries in whatever way they desire. So the trustee or the corporate trustee will make a decision. That's how I'm going to distribute the income. So so I could decide where that money is actually going to go. I could even channel it out through another company, or or distribute some of the income to my kids, just to minimize the tax. So the assets of the trust are also protected in the event of litigation against beneficiaries, as there is no single individual that owns any assets, or so therefore creditors or an individual cannot access any assets held by a trust. So in that scenario, what this means is that the trust actually owns the property. So if you get sued somewhere else for doing something else, they can't come to get that property off you, because that property is not owned by you, it's owned by the trust. And that's where the asset protection aspect of it comes in. So if you're a doctor, for example, and doctors have to do everything in their own name, and I know that because I deal with doctors, and they make a lot of money, and they've got to do their negative gearing, whatever. But they also are in an industry where people can actually sue them for any kind of negligence. So for that reason, though, you'll often see a lot of high-paying professionals, even if they are not high-paying professionals. I do that myself, where I don't have anything in my name individually. There's nothing in my name. Everything is in a trust, and I personally don't put more than one property in a trust. Yes, I have to pay the ASIC fees every year. I have to pay the accountant for a separate tax return for it. Yeah, no problem. Those are very minor expenses for me in the whole scheme of things. I keep only one property in a trust. You could keep two properties in a trust, doesn't matter. But what you need to understand is that if you're the landlord there and you've got two properties in a trust, and if somebody sues you, sues that trust, or your tenant, I don't know, slips or breaks their head or whatever, because you as a landlord was negligent, and if they sue you, both the property that they've got, they can actually, if you get if you're guilty, then they have the right for they can actually make a claim on them and force you to sell them and get their settlement or whatever. But the best thing is, if you want to do asset protection and if you got debt on it, nobody can touch it, because the first right goes to the bank. So a company can be a beneficiary of a trust, ensuring that the tax rate is capped at 30%. So because the other good part is that when you got a corporate trustee and you make a lot of money and you want to use the same trust, or you sold everything out. So it's not like I set up a new trust for every development. Once the development is done, I wrap it up. But I have other trusts. I call them my working trust. The way I set them up is that, for example, I've got a trust called XYZ, and that XYZ trust becomes a shareholder in all different developments where I'm not going to keep any unit. So once the development is done, money comes in, it comes back to me, it gets distributed to that trust, and then the development entity trust is wrapped up and finished. And I'm just 2 slides away from a visual representation of this so you can understand it much better. So beneficiaries who receive capital gains can claim the 50% capital gains discount where the asset has been held for more than 12 months. So most of you would know how capital gains tax works. If you hold one of your units and you hold it for 12 months and then sell it, you only pay capital gains tax on 50% of the gain. So let's say you bought an asset for $100 and you held it for 12 months and then sold it for $200. So you will only be taxed on 50% of the capital gains, which is $100, but you'll only pay tax on $50 because the total capital gain was 100 and you only pay tax on 50% of it, which is $50. So that is what you'll pay the tax on. If you sell it within the 12-month period and you've made $100, you pay tax on the full $100. So always remember that this is. So beneficiaries who receive capital gains can claim the 50% capital gains in. So what happens is that if the trust held the property for a year and then sold it, so whatever the capital gain was or whatever it is, it can be the individuals who are the beneficiaries in that, and the money is coming to them, they can also claim that 50% discount on capital gains. So the advantages are the streaming of income to lower tax rate beneficiaries. The small business concessions can flow to the ultimate owners with no reduction in value. Trust deed can be tailored to the needs of principal and beneficiaries, can make flexible distributions of income and capital. So you could have one trust which makes a lot of money, and you can then use that to distribute it to, based on what your deed says, to other entities that you may own or do. But the only difference is that if I have a discretionary trust or a family trust, they are both very similar. They are one and the same thing, I think. But check with your accountant. Family trust and discretionary trust are more or less the same. But if I was to do a development where I had other parties involved which are not related to me, I would do that in a unit trust because it functions more like a shareholding company and all of that. But if I was to do a development where I was going to keep a unit towards the end, or it's just going to be me and my wife and we're doing a duplex, I would do it in a family trust. Because it's my family, it doesn't have to be a unit trust. So I only use unit trust when I do development with unrelated parties. So that's where I use it. But I mean, your accountant could advise you that you could use a unit trust for yourself, but it's between you and your accountant. I don't. So yeah. So asset protection available through correctly drafted trust deed. Extra, as I said, trust deed is very important. So you will need to tell your accountant this is what you want to do. Extra asset protection available through use of a corporate trustee. So these are some disadvantages. The accumulated income is taxed at top margin rate. Losses are trapped in the structure. So you can't distribute your losses. So say for example, you make $100,000 loss in a development or a business, for example, that had that. So you can't distribute that loss anywhere else. It will stay in that structure. You can distribute the profits. So the way the discretionary trust and the unit trust work is that they work through a profit and loss of zero. They've got to have a profit and loss of zero. Why? Because their balance sheets work differently to a company. A company has a profit and loss, so there'll be a profit or a loss, something like that. Whereas in a trust structure, the profit and loss is usually zero. So whatever it is, it gets distributed. Whatever profit comes in gets distributed, but the loss stays in that. So more costly than sole trader or company beneficiary, can be subject to complex PAYG calculations. Don't ask me what this is. I know what PAYG is, but I don't know what these calculations are. Check with your accountant. May be restricted in who it can deal with after making a family trust election. Varying the terms, trustee can be personally liable for the debts of the trust. It's always the case. Anytime you borrow, the director in the corporate trustee or whoever the trustee is, if it's an individual, will be personally liable for the debt of the trust. So someone's got to be liable for the money that you're borrowing, whether it's you're borrowing or whether the trust is borrowing. If you are the director, you are liable for it. So you're not entitled to the tax exempt threshold. So that's how it looks like. So there's a family trust and there's a corporate trustee that sits on top of it. The corporate trustee is nothing but a PTY LTD. So it's like a proprietary limited company that sits there. It has a director or directors, and it would have its shareholders. Whoever controls the shareholders, the maximum number of shares, controls who the director is going to be. So these shareholders, so say for example, you put me as a director there, but you guys are the shareholders. If I don't perform or if I'm not doing what I'm supposed to do, you guys can fire me and get another director to be the director of the corporate trustee. Now, so far what we've explained is that this is the corporate trustee that determines how the beneficiaries who sits at the bottom, or how the beneficiaries, normally the family members in a family or discretionary trust, how that money will be distributed. Now there's an appointer who decides who the corporate trustee is going to be or who the trustee is going to be. So as such, the powers conferred on the appointer of a discretionary trust will depend on the trust deed. As I said, everything is determined by the trust deed. A trust is only as good as the trust deed, what the trust deed dictates that it can or cannot do. So that is why don't hop on the net and buy a $200 trust deed, because you don't know what you're getting and you might be wasting your money. So always check with your accountant, ask him, how it can be done, and then they will explain it to you. As a minimum, a good deed will usually provide for the position of an appointer and confer upon them the power to appoint or remove the trustee. Called discretionary under the trustee is given the discretion to distribute the income. That means these guys. So this guy decides how to distribute the income. This guy decides who the trustee is going to be. So that is what the relation is all about. And a settler is your accountant. It's the guy who's putting it together for you. So he has to pay $10-20 and he can't be the beneficiary. So these are the things that you need to understand. So trustee decides who gets what. Only profits can be distributed. Losses cannot be distributed. It must be spelled out in the trust deed how the profits are going to be distributed. Trustee can be an individual. I would not recommend or have my own trust with an individual trustee. If your accountant says so, please go ahead and knock yourself out. But go with what your accountant has to say. Although many discretionary trusts are often referred to as family trusts, that is having been set up to benefit a particular family reference. Now, this is again the same thing. As I said, they are more or less the same. So we'll zip through that. So all this is saying is that I would prefer to do all of these things in the discretionary or the family trust, which is one and the same thing, only if I've got my family members doing the development with me. That means, and that too, it can't be your long distance cousin or your auntie or whoever. It's got to be your immediate family, like your brother or your sister or your spouse or your kids or whatever. So if the litmus test is this: if you and your they see your financial circumstances as a unit with your spouse, or as a unit. So that is why you would want to be able to do these things together. If you got unrelated parties like your friends and everything, they are not part of your family trust. In that scenario, if I was to do a development with a friend, I'd still use a unit trust. So they've got advantages and disadvantages. So there is no searching for any register. Well, there's some technical stuff. You guys can read all that. So let's look at what a unit trust is. The unit trust is very similar to a company, but the unit trust also has a corporate trustee, which is the PTY Ltd, and there are shareholders and directors, or a director. And unit holders are very similar to what the shareholding is. But what happens, the difference is, in a company, money would come in and taxation office will take away the $30 before they distribute the $70. Whereas in a unit whereas in a unit trust, the $100 can come in based on your trust deed, and that $100 gets split into the unit holders, all of it. And then it's up to the unit holders' capacity, their own individual tax assessment of what they're going to be taxed at. So a unit trust is a trust in which the trust property is divided into a number of defined shares called units. The beneficiaries subscribe for the units in much the same way as shareholders in a company subscribe for shares. In any ordinary unit trust, a beneficiary is entitled to the income and capital of the trust in proportion to the number of units held. So unit holders agreement. So yeah. Now the main thing is this unit holders agreement. So just like there's still a trust deed that will dictate what it is, but when you got unrelated parties sitting at the bottom here, you've got unrelated parties. So let's say let's say all 10 of us, for example, come in and we hold 10 units each. So there's got to be a unit holders agreement that dictates how all 10 of us are going to behave if when some money is required to be put into the development, when the profit needs to be distributed, or who's doing what. So it's like a JV agreement that stipulates everything that needs to be done in the trust. So I'll give you an example. Now, I can't give you a copy of this because this is confidential, and this is a sample copy of a unit holders agreement for the 230 Station Street, the development they're just finishing. And what you can, it talks about all the different things. So I mean, this is just normal legal jargon, business policy, who's going to keep the accounting records, accounts and access, what are the ethics, what are the voting rights, all those things. So basically this sort of, so when you've got a unit trust, it's better to have a unit holders agreement than a JV agreement, because a unit holder agreement would dictate how the unit holders in that unit trust are going to behave throughout the development. So you could stipulate that XYZ person is actually going to look after the bookkeeping, or John's going to look after the project management, or Ashley's going to look after the marketing for this, or Will's going to look after the construction for this, or Andre's going to look after the project management or the tendering process. So you can write that down in there and say, and stipulate who's going to do what. Also, let's say you get to a stage where the bank says, look, guys, we've got to this, I can approve your loan if you guys put in an extra $100,000. So that's another developer's equity injection that's now required for you to get your development across the line. So the unit holder would dictate that all of you would have agreed before getting into the development that yes, so if there's $100K required, all 10 of us have to come up with 10 grand each. Now what happens if somebody doesn't come up with that 10 grand each? That also needs to be put in the unit holders agreement before you get into the development, because then it becomes a crapshoot, and you don't want to be in a crapshoot situation. And I've been in a very tight spot like that where my partner ran out of money and delayed the development for 4 months. So 4 months of holding costs and 4 months of delay on the development, just because he had no money. So we tried everything over. But my biggest problem was that I did not have a JV agreement set up in that, because it was done under a partnership. So that it was my fault that I didn't have that JV agreement in there, so I couldn't go after him. But I didn't want it to get into a fight. All I wanted to do was finish the development in somehow. So we waited 4 months, and I looked under every. I basically turned every stone to make sure that we got money and everything. But we managed to do it, and we got the money, and we finished the development. But in hindsight, I would never do a development again without a unit holders agreement in place that dictates what we're going to do, how we're going to do, who's going to do what. So that is very important, because when you're getting into a development, everything looks rosy, but so many different things could go wrong or don't run as smoothly, and then people start going. Start pointing fingers at each other that this happened because you did that, or you should have done this, or it becomes a crapshoot, and you don't want to do that. So you got to think of every possible scenario that could go wrong, and you got to account for it. You got to have an exit strategy. You got to say who's going to do what. If somebody doesn't have the money, would other people lend him the money? If they do lend him the money, are they allowed to borrow his take over his share, or are they allowed to charge him an interest rate? All those things have to be thought of before you guys get together. And the reason I'm bringing this up is because John's been very active putting a group together, and I want you guys to come together. But you guys have to sit together and say, look, hey, we're all friends, we all love each other. The aim is that we want to complete the development. So if your aim is when for whatever reason you guys hit a snag along the way, and all you're looking for is that, oh, that's his problem, or he did that, or he should have done this, and he's to blame, it's not going to work. That is why I'm very picky of the people that I get into a development with, because I don't want any guns. I don't want anybody pointing the guns at me when I'm doing the development. If there is a problem, I move heaven and earth to make sure that I solve the problem rather than finding somebody to blame. So I'm there to actually solve everything. So at that time, I would want to concentrate on solving the issue rather than covering my backside because someone's pointing a finger at me or says, oh, as per the contract, you now have to pay me X amount of dollars because you delayed the development, or you did this or did that, and all of that. So I'm very cautious of protecting the development management team and the investors and everybody. If there's a problem, we solve it collectively. And that is why I've had people who had $2 million in cash and wanted to do a development with us, but they were treating us like we were their servants. And I said, sorry, man, you could take your $2 million and you know where to go. So I wouldn't do the development with them. And I'm pretty good in that sense. When in a couple of meetings I can tell who the kind of person they are and whether or not I want to do a development with them. So that is why even my business partners, I'm with them because we all share the same value system. We're not there to point fingers at each other, and I trust their judgment when it's their area of expertise, and they trust my judgment when it's my area of expertise. And we have a situational leadership kind of thing that works on. In some situations, I'm the leader. In some situations, they lead and I follow them because they know more about construction or project management or anything else. But if anything comes to the field that I look after, then they follow me because I tell them, look, we can't do this. That's it. Finish. So, and the same kind of chemistry has to be between the people who are getting into the development. Always remember, anything could go wrong, and the other part is anything that can go wrong can be fixed as well. But when you're doing your first development, everybody tends to panic and then start pointing fingers at each other. And what you need to do is you got to come together as a group, look at each other look into each other's eyes and say, look, mate, I'm going to be with you forever. Like, we're going to see this through. And if your aim is to solve the issue and rather than blaming each other, these these agreements and all those things are not going to bother you too much. And that is how you'll make friends for life or partners for life. And chances are, if you go through one development together and everything is great, you'll keep doing that again and again. So it will have all these things. And who puts this together? Again, I can't give you a template for this because a template is not. not worth the paper is written on, because it has to be specific to your development and to your unit trust and the people who are actually going to be in there. What I can help you with, and I will in that scenario, then I'll give you some questions for a JV agreement. So think about it, come up with those answers. So if 4 or 5 people are planning to come together, you guys should sit together, go through each one of them and say who's going to do what. Are we going to put in the same amount of equity? Who's going to drive the project, or who's going to liaise with the consultants? Does every unit holder have to be there for every meeting, or somebody else who's got more time to handle the meeting can handle it and then brief somebody else who's going to do the minutes of the meeting, who's going to do the bookkeeping? Sort all these things out. Who's going to put in how much capital, and if more capital is required, how are they going to come up with that? You should all have a buffer. You should all agree that you have X amount of buffer, and if you get stuck somewhere, how are you going to treat it? Can somebody else lend money to somebody else, or do they lose a certain amount of share if there is an issue? Now, there could be scenarios where I can't even think or comprehend, because the development is the way they work, and the way it could be any kind of issue that you could come up with. So you have to be prepared and have a plan and have an agreement amongst all of the unit holders, that this is how you're going to handle anything when you do hit a snag. So yeah. So the benefits of a unit trust are: define that parties' interest in the assets and income of the trust can be easily transferred, can be reacquired by the trustee. So this is what I'm saying. Where let's say we are in a development and I run out of money, and you guys say, "Look, Amber, you got to put in 10 grand," and I said, "Look, guys, I haven't got the 10 grand. So, but I hold 10 units. So I would say, look, I've only got 5 grand, for example, and I can't have that." So what you would do at that time is, or I would do at that time, is value the value of the property. So if you haven't got a DA, you have to agree that if you haven't got a DA, then the value of the property is the same as the land that you guys purchased, or whatever the cost has gone into it, you add it to the value of the land, and that's the value of the share. So let's say the value of the land is $100, and you might decide in your unit holders agreement how you're going to value it, and how are you going to value it, or how it will be valued after you've got the DI. And if the problem that, I ran out of money, or I only had 5 grand, for example, didn't have the other 5 that I need to come up with, how would that be treated? So I could say, look, guys, did somebody else want to take my shares? Now, if I was to bail somebody out, I would put that in the unit holders agreement, that I will buy the units at the cost of the land, not the value that day, because I want some benefit. And also, if the value of the asset in the unit trust is over $1 million, there'll be stamp duty on it as soon as I buy the units. So if the value of the land is $1 million, is, let's say, $1 million, and I've got to buy someone out for $100,000, I'll pay the 100,000, but I'll have to pay stamp duty on the 100,000 because the value of the asset is over $1 million. So when those units are going to move, I'll have to pay that. So I might put in the unit holders agreement that if I have to bail somebody out, I would pay them $100,000 less any extra stamp duty that I might have to pay at that time. So before you get in, people think 10 times that, look, I'm getting in with 100K, but I've got another 50K to back me up if more money is required down the track for whatever reason. Could be your valuation came in low, could be the bank changed their policy, could be APRA came up with another layer of stricter conditions where the banks didn't want to do it. Anything could happen while you're getting your DI. So that's how the development works. You'll have the unit holders who will sit at the bottom of the unit holder. There'll be a corporate trustee that'll be making decisions, liaising whoever the director could be somebody else. And then this development entity would be developing the townhouses as we go along. So yeah, so that's how a family trust works. So you'll have a corporate trustee, so the way it's written is that ABC Pty Ltd, sorry, I didn't put the Pty Ltd here, as trustee for, ATF stands for as trustee for ABC Trust, or ABC, it's just, if it's a family trust or discretionary trust, they just say ABC Trust. Now, you go and get an ABN for this. You may or may not get an ABN for it, doesn't matter. Your accountant will be able to tell you that, how that works. And then there'll be shareholders and directors there. Also, you could have another trust sitting somewhere else that keeps all the shares and are held by somebody else. So you could make it as complicated as you want or as simple as you want with this. And then you'll have beneficiaries here. Could be husband and wife, kids, whoever. Um, uh, Whoever the beneficiaries are in that family. In a unit trust, for example, this is called Yeehaw Unit Trust. I said I put Yeehaw, so this is a really dry topic and some of you might be sleeping right now, so I thought I'll put Yeehaw's. It'll wake you up, wake you guys up. So it's called Yeehaw Property Pty Ltd as trustee for Yeehaw Unit Trust, and it has the same structure, but the unit holders could be party 1, party 2, party 3. Now these parties can be individuals. They can have their own trusts that hold the units in the development entity. So let's say Yeehaw Unit Trust is doing a development. I would have my XYZ working trust that I use to hold units and sell everything out, get the money in my other trust, and then it gets distributed to me. So you'll have to really think how you're going to go about it, and go talk to your accountant. If you guys are coming together, you need to get together collectively. Now, your accountant will not put together your unit holders agreement. A unit holders agreement is put together by a lawyer. Your accountant will give you the trust deed and the unit trust and the corporate trustee that will work all of that out. But for the unit holders agreement, you take all the details of the newly formed trust, go to your lawyer, all of you get together, and you spell out this is what we want to do. And then the lawyer will put together the unit holders agreement for you. So the advantages of a unit trust are easy to introduce new equity partners. So let's say I run out of money and none of you have any money either, but all of us have to come up with 100K each, 6 months down the track. Now I might find somebody else, or you guys might find somebody else and say, look, Amber, you haven't got any money to continue with the development, and based on the unit holder agreement that we put in place earlier, we found somebody else who's interested to be a partner in that. They will buy you out. So they might come in and I'll transfer my units to them, and then they can come into the development and I'm out. So that way, whatever extra money is required, they come in that extra and pay me off what I had put in the development earlier, less any fees or whatever that might have cost people, because it's an inconvenience. If a unit holder runs out of money midway, it becomes an inconvenience to do the development, and it's holding other people back. So there should be certain things that you need to stipulate that all of you are subject to if somebody doesn't come up with the goods when they're required. So when non-related parties are in trust together, interests are fixed. So that means, when you say fixed, that means it's based on what your unit holding is. So you do a development and you make $2 million, you can only be given that $2 million will only be distributed based on your percentage of the trust of the units that you own in the development. 50% discount method for CGT is available. So if the trust held a property for a while and the CGT, that 50% discount, if you hold it for 12 months, can be passed on to the individual unit holders. Small business concessions can be accessed, simple to wind up, asset protection available through correctly drafted trust deed, no regulator, substantiation rule less onerous than those imposed on individuals. I've got no idea what this long word means. Check with your accountant. Flow through the small business concessions reduced by cost-based adjustment. If the trust is funded by debt rather than equity, disposal of units can lead to large capital gains. Look, you're getting into this to make money, so don't worry about large capital gains. That's what you're there to do. A change in unit holding can make pre-GST assets pre-CGT assets to post-CGT assets. I've got no idea what this means. Check with your accountant what exactly would that mean. May not be able to elect to be a family trust, so you can't convert a unit trust into a family trust later on. Losses are trapped in the structure, so you won't be able to distribute them. Cannot transfer losses to other controlled entities like companies. So clients can have trouble understanding all terms of the deed. So it's not that difficult. Understand that the money comes in, can be distributed to all the people, and then it's up to them and their individual tax assessment of what they pay. So that's pretty much it. And you're liable for it based on the percentage that you own. But if you go to a bank and all of you are director, which you all should be, it would be jointly and severally responsible. So now, advantages of having a company as a trustee, that's pretty good. I think we've discussed all of these. There are certain details. I want to spend some time talking about answering some questions because I know some people are getting together to do a development soon. Hybrid discretionary trust can be hybrid discretionary or hybrid unit trust. Now, hybrid is like a combination of the two. So family and unit trust, all they take the best and put it together. I've never used any of these, and I have never seen anybody use these in a development so far, but they could be used. But again, you've got to have a very specialized need to be able to use them. My accountants never advised me to use a hybrid trust ever for different kinds of development. So different terminologies. Remember, the appointer is the guy who sets up who the trustee is. Trustee is the one who decides how the money is going to be distributed. Appointer can actually fire the trustee, whether it's an individual or a corporate trustee. Settlor is the one who sets it up for you and pays 10-20 bucks, can't be related to anybody else in there. And these are certain terms that are there for you to read. I'll give this to you. I'll also show you, you got to understand a little bit about super funds. I'm not an expert. In fact, if you go to an accountant, even your accountant would tell you that I can't advise you on self-managed super funds because they are all, it's so specialized that the accountant would also refer you to somebody to do that. And not only that, I've seen different specific trust advice that I went to get from my accountant. And what the accountant does is that if he or she is not sure of what advice they're going to give you on that, they refer you to a accounting barrister, where you go to a barrister and you ask them, this is my situation, that's what I want to do, and then I don't want to pay the stamp duty, and then I want to save on my GST, or I'll do this and I'll do that, and that'll save me this EGT. It could be a very complex situation where it is better to go and see a specialized person and get written advice from them. Make sure you always get a written advice from them. So don't take anybody on their word. And if somebody can't give you an advice in writing, that means they are not sure of it themselves. So and I've seen a lot of accountants do that. They, if they are not sure of something, they would tell you up front, look, I don't know what this is, but I can get you an advice from a barrister. And that advice would come in writing, and then you have that. So in case you get audited somewhere and you've saved some tax for whatever loophole that you thought was possible, at least you've got a written advice from a tax barrister or a tax law expert or whoever that is, or a super barrister or a super law expert. And if you've got that in writing, at least you can tell the ADO that, look, I acted based on this advice that I got from XYZ lawyer. And if they then advise you wrong, it's not your fault. ADO will go after them. No skin off your back. You've complied and you've done your job. So always remember to do that, to get specialized advice from people who specialize in that field. Now, super funds are also a type of trust and are an investment vehicle which can be used to contain investment purchase with your super contributions. Now, I haven't got a super fund at all because I've always worked for myself, and for me, so far my super has been all the assets that I own now and the rent that I got. So that's, for me, it's my retirement is the assets that I own. So yeah, the main purpose of super is to provide retirement benefits. So it is important to remember that money contributed to a super fund is generally not available until you retire. So it's pretty straightforward. But super fund is simply a form of trust designed to provide retirement, blah, blah, blah. Provide the trust deed and the operation. This is all basic stuff, but I want to have, this is the main stuff that you need to know. And as a developer, you need to know this, because when you start putting these projects together, people come to you and say, oh, I want to put money in this development. Can I use my super? Well, you are not the right person to advise if they can or cannot use the super. So you need to tell them, go check with your accountant or a super specialist that. But as a developer, you need to understand this, that any lender will not lend you money onto the development entity if the first layer of unit holding or shareholding is held by a super fund. And the reason for that is that they can't have a clawback clause or whatever that is from a super fund. And I've come across this myself with second tier lenders, with shark lenders, and even with top four banks, where I've called them and I qualified because an investor comes to me and says, look, I want to put money in there and I want to use my super fund. And I said, look, mate, you need to go and check with them. So far as I'm concerned, the first layer of direct shareholding can't be in your super, because that entity will not be able to get any funding for construction. How you do it, it's not my area of expertise. And people will come to, they keep asking you as if, you're the super expert, and I'm not a super expert. I will not, I won't advise them. So, but I know this much, that the development entity eventually has to go and get construction finance. And if there is a super fund holding units in it, or a super fund who is holding shares in it directly, though no lender will lend me the money for construction until I change that. And it could be a problem for the development going forward. And that is why I never allow that. And there are ways around it. And I will not advise you what ways are around it. If you ever come across something like that, start calling up super experts and start calling up accountants, and they will advise you on how this can be done, or whether or not it can be done at all. So yeah, so the fund only pays 15% tax. So most people want to do that because, I'll use my super and all the money comes into my super, and the fund only pays 15% tax. Well, that doesn't quite work in a development as such, because taxation office is aware of all these things. So yeah, is reduced by imputation credits on dividends received by the fund. Capital gains of complying funds are subject to 33.33% discount where the assets have been held for at least 12 months, meaning that the tax payable is effectively 10%. So these are the tax advantages that you need to be aware of as a developer as well. Of this is just pure general knowledge available for free from the internet. The trustees, who are also the members, control the investment decisions and asset mix, and have the flexibility to change investments when they consider that this is appropriate. That is, they are not locked into a fund manager's mandate or poor returns. So I may have some money somewhere in a super fund, set up by an employer for all the little time that I did a job. But apart from that, which is not a lot, and I can actually find that out pretty quick. But I can't touch that money still. And at some stage in the next 2-3 years, I will set up a self-managed super fund, and then do some contributions to it, so that I can then eventually hold a unit in there or hold a property in there. So it just depends upon where you are in your situation with that. So it's a good strategy because there are tax incentives with the money in the super, but it's not that straightforward to actually just go in and buy a property in there. Your super should have enough funds in there to be able to get the deposit and be able to afford the monthly installments. There's some benchmarks in there that you need to check with a person who specializes in super. So basically the government's put that together so that it helps you with your retirement. So there are different things. These are the things that you need to know. Cost of compliance and admin are often less than the fees charged by a public super fund. And the members don't get charged an entry fee when they contribute to the fund, or an exit fee if they withdraw their benefits. People who are running a business can own their business premises in a self-managed super fund and rent to themselves or to a related party. So what you can do in this scenario is, for example, let's say I buy a commercial property in my super, and then I lease it to my own business. So I'm allowed to do that. So these are the things that you need to know as a developer, because when you get to a level where you can do something like that, you should at least know that, look, I can do this in my super, and how you're exactly going to go about this, you can at least go and find out and get that advice then. But if you're not aware of this, you won't even look for that advice. So my job is to make you aware that these things are possible. The fund may also own residential investment property so long as it buys it from or leases it to an unrelated party. So there's a different definition for related and unrelated parties. I haven't gone to that depth to explain you what a related or an unrelated party is. So it safeguards your assets. For example, super fund investment can be selected and where properly integrated with members' personal investments within limits. So these are different details that you can read about, and I would highly recommend that you read about rather than me just talking about it, because it's a really dry subject. Not a lot of people do that. So types of assets that can be acquired by a self-managed super fund from a related party. So they've got a related party definition under section 10 of SISA. Don't ask me what it is. Self-managed super, I don't know what A stands for. Is very broad, includes members of the SMSF, any business associate, blah blah blah. It's all there. You can read about it. So a relative, for example, of a member of a self-managed super fund includes a spouse, parent, grandparent, brother, sister, uncle, aunt, nephew, niece, lineal descendant, or adopted child of the member or his or her spouse. So anytime when you can't buy assets from a related party, just make sure this is what a related party constitutes. But then again, anytime you want to involve something like this, go and get proper advice. So it's got to be a sole purpose test. So the investment must not conflict with the sole purpose of providing retirement related benefits to the member and or dependent of the self-managed super fund. Arm's length transaction, the purchase price paid on the asset acquired by the self-managed super fund must be at market value, and the transaction must be conducted at an arm's length. So it can't be that you do a development on your own and then get your super to buy the unit from your own development. So that's what it means. So it's not allowed. So again, get advice from a proper tax guy, because these things get audited all the time. So if there is a breach, you might have to pay normal taxes on whatever you acquire in your super fund. Investment strategy: the asset acquired by the self-managed super fund must be in accordance with the investment strategy formulated for the self-managed super fund. And borrowings: if the self-managed super fund needs to borrow money to acquire the asset, then the borrowing must be structured correctly in accordance with the limited recourse borrowing provisions. Now that's where this is. When you say limited recourse, that means the lender can't come after you. So it has to be, all that borrowing and everything has to be very specialized. And there are brokers who specialize only in self-managed super fund borrowing, and there are brokers who are mainstream brokers and would have no clue how does the borrowing in a self-managed super fund would work, because again, it's a specialized field. So even finance brokers are specially trained to be able to help you get finance for that. So this is like a summary table where in an individual partnership, company, unit trust, discretionary trust, super fund, cost to establish, high, low, whatever. So it's like a glance through that you can use. And if you want to find out more about these details, these are the resources that I've used to put this slideshow together to be able to explain to you, because obviously I didn't make these things up. This is an acquired knowledge as far as I'm concerned. So now, anybody's got any questions, please press the hand button and I would be happy to point you in the right direction. And if I've experienced something like that before, I can share my experience with you. But I won't be giving you any advice on any of these things. So press the hand button and I will give you the mic. Okay, no question whatsoever. Okay, tomorrow, what we want to do tomorrow is I've got Will and I've got I think Casey mentioned something to do a real life case study. So tomorrow is a tutorial class and I do not have anything to discuss or teach for tomorrow. So tomorrow what I want to do for tomorrow is, if you guys have been looking at properties, okay, John wants to say something. Hang on one second, John. Okay, John, go on.
Please continue what you're doing. I can wait now.
Yeah, I was gonna say that for tomorrow, what I would want is that if you guys have been looking for properties, looking at deals, you want to do the due diligence on them, you want to do the numbers on them. I want to do that live. I want to do that in front of all the students from the scratch. Whatever you've got, whether it's one property, two property, we've got up to 2 hours, and if I can discuss 4 different deals in the 2 hours, I'm happy to do that. But bring real life scenarios, ask your questions. I want it to be an interactive session for tomorrow where we can do a live feasibility, due diligence, have an action plan of the things that you need to do or find more information. Or if you've got questions where you're trying to do something and you say, look, I can't find this or I can't find that, or how do I do this, I'll be that's what I want to do tomorrow. John, go on.
Amber.
Yep.
Just want to have a quick chat with everybody about the JV that we're looking to put together.
Yeah.
Obviously,
John, everybody can hear you, so you should tell everybody what you're trying to do. And
yeah, sure, I'd love to.
yeah, talk about it. I've got no problem.
Thank you. For those who have shown an interest in it, there is currently 6 of us that have had a chat about the relations, and the finances are looking really good. And I know Shane is still in New Zealand, and I'll have a chat with Shane tomorrow when he returns from New Zealand. So we're looking to get together Saturday, the following Saturday, preferably in St Kilda afternoon. So we can just sort of share ideas, thoughts, concerns, and just have a really open discussion. I think the point that you made earlier, Amber, about if you enter into a JV with everybody,
yeah,
a relationship that you're in there together, and it's not about pointing fingers and
correct.
At the end of the day, we've got to be problem solvers.
Yeah, that is the reason I wanted you guys to get together. And even if you're interstate and you can't be part of it because you're not here, doesn't matter. Have a chat over Skype. Get to know each other. Talk to everybody. Do FaceTime. Do whatever time you want to do and connect with each other. And then if you're ready and you say, look, I want to move this, that's when you travel. So you might decide to travel once or twice or whatever, but you can do everything and keep everybody in the loop, go through everything. So that's what I'm saying. Whatever deal that you're looking at and whatever finance, present it tomorrow. I'll give you the mic, I'll give you the screen so you can share your screen and everybody can look at what you're doing on your screen or whatever you're talking about. The only request is that you should have a good mic, or you should be very close to your laptop so everybody can hear you, because when you talk, sometimes the voice drops and sometimes it comes back. That is my only request. Mics are usually cheap. You can pick it up from Officeworks or something. And I'll help you structure it. I'll guide you exactly how to go about it. We'll do the numbers together. We'll do the due diligence together. And if there is information missing that you need to source or engage a consultant, I'll point you in the right direction of how to go about it.
Thanks for that, Amber. Yes, so it's been a really good response. I know that Neil is heading off overseas shortly. He's shown a interest in being involved as well, and I think Neil's going to actually effort to come down and see us at some stage when he returns, which will be fantastic. Obviously, Neil's in Sydney.
Yeah.
Really good to catch up with him face to face.
Yeah.
The question that I actually had, Amber, is if we as a JV were in a position to pool our money together and our land upright and upfront have any holding costs, from a cash flow and interest.
Sorry, John, I think you're breaking up a little bit. I got you to the point where you wanted to get together and buy the land outright.
Is that better?
Yeah, it's better, but I would basically, I want you guys to get a longer settlement as long as you want. As long
Sure.
as long as you can to minimize your holding costs.
So, what if we were in the position to purchase the land without having to borrow money?
If you can get to that position, then there is no holding cost, and you know exactly. There's no lender involved or anything. And when you're ready for construction, so let's say your land is $1 million and your construction is, let's say, 1.2, the bank might just ask you to get one pre-sale, and there's no serviceability required at that time, because commercial loan at the time of construction works very differently. So all the bank needs to see is that, okay, I'll lend you 70% of TDC, okay, whatever that is, and they will look at what the equity is in your land. They might ask you for maybe another 100K if the 30% is not fulfilled by the equity in the land. But if it usually it is over and beyond that. So when is that? They might just say, look, just get us one pre-sale and here's your loan.
Beautiful.
You know, and I don't expect you guys to go and do like a 20 townhouse development. You might be looking at 2, 3. I wouldn't say do a duplex, but you can do a duplex. But duplexes have a very little margin in them. I would say 3 or more, or 3 or 4 townhouses, and then it can be handled. It's not rocket science, and it can be handled by this group.
For sure. Look, effectively, we're certainly up around that figure that you're talking.
Yeah.
Hence the reason I said if we could purchase the land outright, obviously we wouldn't have holding costs. And also, obviously, if we owned the land, the bank would look pretty favourably upon that, as far as 60% of the development cost as being a loan.
Yeah. Why don't you present that deal tomorrow, and I'll look at the whole thing. We'll look at the land purchase price. We'll look at what we can put on it. We'll look at your due diligence period, how you're going to structure the deal. We look at all of those things, and I'll put an action plan together for all of you.
Okay.
Hello?
That's great.
Yeah. All right. Is there anything that you'd like to add? I've got Ashley in the queue who had his hand up for a while, and then he stopped that. Then I've got Andre, and then I've got Will. So I've got 4 people in the queue asking questions. So I've got to hand over the mic to Ashley now. So is there anything else that you? Okay, great. Thanks very much, John. And bring your deal tomorrow. We will look at it closely as a case study for the entire group. Yes, Ashley, I've got you on mic now.
Yeah. Hi, Amber. I was just wondering, could we also look at? Maybe I can try and dig up a permit ready sort of development, but pricing up of apartments versus doing townhouses. So I know in the examples you've given on townhouses, you've just got building costs as a function of internal areas and balconies, etc.
Yeah.
But what about when you've got apartments, you've got driveways, you've got undercroft parking?
Even then, apartments...
Or you might have a lift, etc.
Correct.
Yeah, how do we do that?
Even then, you gotta have a higher square meter rate. You gotta have a higher square meter rate.
And recommendations for finding out construction costs, is there particular, like the Rawlinson's construction guide, or is there any?
You can do that. You can always do that, but they're always off the mark. Like, you won't be able to get the pinpoint. The problem is that no builder will give you the exact price until they've got the working drawings for the apartment. Okay. So it's very difficult. What you can do is is work with an allowance to begin with, and if you're serious about something and your allowance works and it shows you that, okay, it's got good money in it, that's the time when you say, look, I want a 30-day due diligence on this thing. When you go and talk to a few builders, and if the builders won't help you, you go to a quantity surveyor, and a quantity surveyor will charge you something. But apartments or something, they can vary from depending upon whether or not there is a basement, whether or not there is a lift, what kind of finish you're going to put in. They can start from anywhere between $250,000 to $280,000 to $400,000 an apartment for 2-bedder. So it's very difficult to put your finger on just from the permit that's what it's going to end up costing me. But you do ballpark numbers, based on what's available. So if you've got something, I'll be happy to look at that as an example and give you my take on it. But For you to sharpen your pencil and get a better figure or a more accurate figure, you have to either go to a QS and get a cost estimate, or you have to go and talk to a builder who's done similar kind of apartments in the past, and they might be able to give you a ballpark. Look, something like this allow 300 a pop, and that 300 figure would include your drivers, everything. It'll be like a turnkey finished thing. But when the specs change, they might say, look, in my 300k a pop, I've only allowed the builder's range for appliances. But if you want Smeg appliances or you want Bosch appliances, it's a different story. Then they'll say, look, this is what I allowed for. If you want to upgrade to that, that's what it's going to cost you. But as long as you don't sign the building contract, you can go and check prices from different builders. And if you've got something, I will put an action plan together for that as well. The things that you need to do and look for.
Yeah. And the other common one in Queensland is they take an old timber Queenslander house, they put it to the corner, and they build townhouses behind it. I've got no idea what a Queenslander costs to renovate, because they'll renovate the Queenslander, sell that, and sell the townhouses behind it. So, yeah.
Queensland, I've actually got a quote from the builder, the one that I used. But the quote is, I think, about a year old, and he's building 2-bedroom units at 280, 290 a pop, which are the basic range ones. So you can't expect to sell them at 800, 900k a unit. There will be more 500k or 480 kind of range. But I can put you in touch with somebody. So if you're over there, there's a building broker that I worked with. And his job was to, if I send him the development, he will go back and he will help you from the start of the project and to be able to finalize a builder for you. So they get their commission from the builder, but they work with different builders. So based on the development that you've got, you can get in touch with him, and he works in Victoria and in Queensland. I actually used him to finalize a builder for myself in Brisbane. And if you're serious, this guy is serious, and he'll be able to tell you that, look, allow this in your feasibility. You can get in touch with him. And
that would be excellent if you could send me his name.
Yeah, his name.
I'll just add it to my notes.
Yeah, his name is Sam O'Rourke, Rourke, something like. But I'll give you his contact details tomorrow, the whole group can have that. Okay, I've got Andre in queue. Thanks very much, Ashley. I'm gonna mute you now. Okay, Andre, I've got the mic on for you. Sorry, mate. You had to wait
That's
a
right.
while.
All good. Hi, everyone. This is actually just more of a comment about super funds.
Yeah.
Years ago, they used to advertise for super funds that it was basically your money, everything else. And then I actually noted one day when I was watching a parliament sitting on ABC, one of the ministers actually get up and turn around and state outright that super funds are Australia's best national asset. My point about this was after that is when I set up myself managed super fund, is because that sort of underlying comment that he made sort of made me stop thinking, okay, this parliament might have a way of actually doing cash grabs later on down the track.
Do you
Not
know
so much to trust what their legislations are.
the richest companies and the companies that make the most profit and everything, like the top 20 or top 30, something like that, they're all super funds. These super funds are the ones they actually own things like airports and big leases on massive properties in the city or massive commercial properties with anchor tenants like Woolworth or some really good tenants that they would have. And if you, for example, Quest Apartments or something. So if you were to develop apartments like service apartments and then have a lease and everything and then sell it to somebody, then you can actually sell the entire asset base to a super fund, and they will hold it and keep making the rental income for the fund. So
Yes.
yeah, so that's what they do.
Yeah, it was just a point of interest.
Yeah.
Yep.
All right. Thanks, Andrew.
That's all.
Okay, I've got Will next. Hang on one second, Will. Okay, Will, you're on mic.
Hi, Amber. How you going?
I'm very good.
That's great to hear. With the note that John was mentioning before, you know how he was saying that if we were to buy the property in cash, we will, of course, be minimizing our holding costs.
Yeah.
Now, could we achieve sort of the same outcome in terms of minimizing the holding costs if we were just to go for let's say a 10-month settlement or a 12-month settlement with only a 5% deposit
Yep.
for the property?
Yep.
So instead of buying the property in cash, I mean, could we potentially just do a long-term settlement?
Yeah.
So we don't have any
so
holding
what?
costs.
So let's say it's $1 million for the property, and you give a
Yeah.
$50,000 deposit, which is 5%, and you
Yeah.
get a 10-month settlement on it. So you don't have to come up with the rest of the 950,000 tomorrow. So even if amongst all of you have the 950,000, that 950,000 can earn some interest sitting in your own account. Correct?
Exactly.
So, and you're using that time. Even if you had the money, I would never buy a property outright. I would get as long a settlement as I can and use and bring my money out as late as I can in the development, because that way I'm leveraging off time. I'm leveraging off the vendor's money. So if you get that 10-month settlement, and you might only need maybe 50K to get your DA. And once you get your DA, you might say, look, once we've got a really good development approval on this, why don't we just put it on the market and sell it? So you might have bought the property for $1 million. After DA, the property could be 1.2 million. And if you just sell it, all of you just you put in 50K and all of you just walked away with 200K.
Yeah, I think that's what another thing that a few developers do. Hey, they make this another sort of business as well. They just get everything together.
It's called you either get an option or a longer settlement or so on. But always remember that you will still have to pay the stamp duty on the $1 million that you bought, and whoever buys it for 1.2 will pay stamp duty on 1.2. Now that's irrespective. But I wouldn't do something like this with only 50,000. Are you with me? I would have the full $1 million sitting in the bank account, because if for whatever reason I need to settle on it, I can settle on it.
Yeah, exactly. I guess if we were to have that much cash, we just really need to be smart in when to inject the capital in the best way possible.
And that's
we
what
could
makes
just minimize holding costs by doing a long-term settlement.
Correct, and that's how you do it. And if you can do something like that, you could do a development of any size.
Exactly, because of leverage. Amba, do you find, like, when you see these, I've seen some sites and I've tried to do some feasibilities on a couple of sites that had already plans and permits.
Yep.
Do you find that people put these plans and permits on, let's say, realestate.com or developmentready.com? Can you see, like, I'm having issues finding like an attractive development margin in these sort of projects that already have everything ready?
About 15.
I feel like the vendor.
Yeah, about 40.
Yeah, I think that the vendor.
Very difficult to stack.
It's always below 15. Always below 15 if they have everything ready. I don't know. I think like the vendor goes and gets all of this done and gets a few quotes from the builder and can probably see what will be your development margin, and takes that into consideration, and thus increases the value of the land as much as he can, to the point that he pretty much doesn't let you have any profits.
Correct.
You know what I mean?
Yeah, they do that all the time. Welcome to the world of development, Will.
Yeah.
Yeah.
I think
it is frustrating, but after a while, you'll just say, shit, keep your property, sit on it, no problem. I won't be paying for it. And you'll see that there'll be many sites that come on the market with the DA in place, and they won't stack because they want the world for it. But most properties that will stack, you will make about 14 to 16%, no more. But if you're only making 10 or 11%, I would say let this one go, because if anything happens in the site, it just, your margin's only 5%, and you say, gosh, I did all of this for just that much, not worth it. So you have to be very picky of the battle that you choose. So make sure you pick your battles carefully.
Yeah, and especially if we were to do a JV, we want to try to get an attractive development margin.
Look, agree. Well, I agree that as well. But you also have to look at it this point of view. Let's say all of you guys put together $1 million, and all of you put in 100K. 10 of you come together, and at the end of the development, all of you made 15,000 on your 100K investment. That's 15% return. Let's say in a year you've done everything. but you made 15,000. You have to look at it. What was my investment? Okay, I only made 15%. But what happened in that 1 year? You were a different person at the end of that year because you've now turned over a development. You've gone through the different hoops that were required. So you went through this real life education and came back with $15,000 at the end of it. Because one, the risk was mitigated. There were 10 of you carrying the project together. The initial investment by all 10 of you was lower, was about 100K. And it's like you got paid to get educated in the actual battlefield. So that's not necessarily a bad thing. And you won't be making 15%. If you leverage it off the bank and everything, that 15% could be 35% in terms of return on equity. So your total profit on 100K in, and when the money comes out, could be 35 grand. So that's 35% return on equity. The development margin on cost could be 15%, but your return on equity will always be higher, especially if you got construction loan from the bank.
Yeah.
The only time
return
on equity falls to the same level as development margin is when you do the construction and the land settlement with your own money. So if you paid cash to do all of that by your own money and haven't borrowed anything, your return on equity will be equal to your development margin on cost.
Yeah, and I guess the experience that you win along the project is also worth a lot of money, and it's got a lot of value as well. The experience that we will be getting.
Yeah, if you've got a development, bring it tomorrow. We'll look at it. But do this. All of you who have a development that you want to discuss with me tomorrow, send it to me in an email. So I've got all the files and everything that I need to show you, or I've glanced through it, and I can actually go through the steps that you need to take in the proper sequence. But if I get it I'll be looking at different things haphazardly. And if you email everything to me in advance or an address or whatever, tell me exactly what you're trying to do, and I'll give you my feedback on all of that. We'll put together an action plan. You'll get the action plan, and we'll go from there.
Yeah, perfect. We'll do that tomorrow for sure.
No worries at all. Okay, Casey, 1 second. Thanks very much, Will. Okay, Casey, you're on mic.
You just answered my question. So about about tomorrow, I was just wondering what we needed to send you.
Whatever you can.
The
plans. Yeah. You've got comparables. Send me the questions where you're stuck. And I'll cover that in the class tomorrow.
Yeah. All right. Cool. Sounds good, mate.
Tomorrow's going to be a really good learning curve for everybody. From exactly how we look at the developments, how we approach it, the things we need to do, the missing information, all of those things. And I'll put a mind map together as we go through the class tomorrow. So yeah, and I'll email you guys the mind map. It's like a checklist kind of thing that you can follow. All good? Hello? Casey?
Yeah, all good.
All good.
Cheers, mate.
No worries at all. All right. Anybody else who would like to ask me a question? I think all of you have already asked the question, except for Satish, who's here. Satish, any questions for tonight? I don't see your hand. If you don't have a question, no problem at all. And otherwise, I'll see you guys tomorrow. If you got a question or something or email, send it to me. Send it to that email address that we support@propertydevelopmentsystem.com.au, and I'll pick it up from there. All right, guys. Good night, and